I'm Russ Branson. I'm with Public Financial Management, and we've been hired by the City of Livermore to look at the hotel market studies and market review for the City of Livermore Hotel, downtown hotel. So PFM has done an independent hotel feasibility analysis for downtown, and we focus on two primary aspects of feasibility. First is market feasibility, with key market indicators of average daily rate for rooms, and then occupancy rate, which we'll talk about a little more in a minute, and then expected growth in hotel demand. Second is financial feasibility, which is based on assumed costs, average daily room rates, and occupancy, and the expected value of the hotel at disposition. And so the first market feasibility is, are there people to fill rooms? Financial feasibility, is it economically viable to provide those rooms and still make a profit? And we at the end talk about making an independent determination of how the hotel market has changed over the last few years and if the market feasibility remains for a downtown hotel. So over the last few years, there's been hotel analysis performed by two different consultants, and then a current proposal for a hotel a few years ago. So BAE Urban Economics was commissioned by the city to do a hotel market analysis, and much of our analysis is based on the work that BAE done and updating that. They provided the final report in April 2015, and they looked at both a 50-room boutique hotel and a 100-room full-service hotel, with a 50 to 80-seat restaurant and up to 5,200 gross square feet for conference space. In December of 2015, PKF Consulting provided a summary of conclusions for an analysis that was commissioned by William Dunlop for a 185-room dual-branded hotel with a 125-room upscale hotel with 2,400 square feet meeting space, and then a 60-room extended stay hotel with breakfast, and then bar and cafe style food and beverage. The Presidio Companies, as part of a response to an RFP, has proposed a hotel with 135 guest rooms, 4,000 square feet of meeting space, and 6,000 square feet for a full-service restaurant. So in terms of market updates, the two key indicators that we've looked at are average daily room rate, where that's gone over the last few years. Generally, that is the amount of money that gets charged per room night on average, and then the operating costs are usually derived as a percent of the ADR. And then the occupancy rate, which is the percentage of time rooms are occupied by paying customers over the year. 65% is generally considered a break-even point for most hotels. 70% is making a profit, and above 70% starts to attract additional hotel development. And we'll see that occurring in the City of Livermore. So the average daily rate, and this is from Smith Travel Research, has increased significantly between 2011 through 2016. It's increased 65%. And the blue bar, which indicates the year of data that BAE used in their analysis from a couple of years ago, it's increased 25% from then. So the year-to-date ADR as of March 2017 is $174, so it still appears to be trending up, and those are all good indicators of a strong market demand for hotel rooms in the city. Changes in the marketplace. The market demand and the average daily room rate really are tied in large part to the government rate, because there's a lot of government employees that stay here due to the Lawrence Livermore labs. And so what we've just compared, looking at, again, the blue bar being the data from BAE, but looking at the average daily room rate for Livermore hotels, and then the government rate. So the government rate has tracked along with the Livermore ADR, and so that's increased 44% from 2014 to 2017. So it's both a good sign that it's going up, but it also appears to provide a little bit of a limitation on room rates for the city. So occupancy rate, so this is the percent of time that our hotel rooms are filled in the city. Again, as we talked about before, above 70% starts to be a market indicator for additional supply, a need for additional supply of hotel rooms. So since 2011, the city has been above 73%, and it's above 77% since 2013. So the last 5 years been very strong. And again, through March of 17 this year, it's at 78.3%. So within the same range that it's been. So very strong occupancy. But and what that's led to, and I'll say the market demand expectations, and we haven't changed these from the BAE study, haven't updated them. The basic underlying data for this study has not changed. So they looked at excess demand, which is what was above 70% for Livermore primary trade area, Dublin Pleasanton, secondary trade areas, and then growth in office employment and growth from leisure and travel, group travel, growing at different rates. And based on these factors, BAE forecasts growth in demand for hotel rooms in the primary trade area with Livermore over the next 20 years, of about 469 rooms, combined with Livermore and Dublin Pleasanton, up to 1,314 rooms. Currently in Livermore, there are 599 hotel rooms either being constructed or under review by the city. Now this replaces 156 rooms, so it's net 443 rooms. But this really helps confirm the demand expectations that BAE put forth in their 2015 study. And it also shows that the market has stepped in as the occupancy rates are high and ADR is going up to kind of fill that space. So the upcoming new projects, which are shown here, again, the 599 hotel rooms being constructed are in the city of Livermore and all along the freeway along 580. And it shows location of the potential downtown hotel there off the freeway. Also in Dublin, and this is the secondary market, there's a 127-room Aloft Hotel that broke ground in April, just a month ago. And Pleasanton has a potential site that they've kind of targeted in their Johnson Drive development, but no proposal. So Livermore is really leading the way in terms of adding supply in the overall marketplace. So our feasibility and findings. Financial feasibility factors that we looked at. We've talked about market feasibility. It really depends primarily on a developer's view of what factors will be in place when the hotel is operating. So what do they think they can rent rooms for on average? What do they believe the stabilized occupancy rate will be? And then what's the cost of constructing the hotel? And they talk about per key or per room, and that would include all hotel construction, parking, land, all the hard and soft costs associated with actually constructing the entire hotel. And then the expected value of the hotel at disposition. And this really drives the economics of a hotel, and it's based on a cap rate at the time of disposition, which is a shortcut to looking at value based on your net operating income. So just overall, some of the hotel cost and disposition factors that we used is the cost assumes $225,000 per key. This is based on, and that excludes parking and land cost. This is based off the BAE analysis, but updated for inflation over the last couple of years. And it includes hard and soft costs and estimated financing costs. And parking costs, again, which is not in that 225 number, are estimated at approximately $32,000 per square foot based on the city's parking study. The disposition value is based on a cap rate of 8%, and that's again calculated by dividing the net operating income at time of stabilization by the expected cap rate, which we use the 8% amount. So those are the factors that a developer will look at in terms of what drives the economics and does this work from a financial basis or not. So the hotel feasibility results on the market side, the increasing ADR, hotel occupancy are good indicators of feasibility. We think a downtown hotel could provide a different segment of the market, and would probably need to be a different segment of the market than what you're developing along the freeway. And they offer a different set of amenities and experience. So even though there is supply coming in to meet the demand, we think there's most likely room and it's feasible to add some additional supply as long as it's offering some different amenities and a different experience than those the other hotels that are being built. And then on a financial basis, running our model with assumed revenues and costs, so we've talked a little bit about that 100 to 135 room hotel we think could have an internal rate of return above 10%. That'd be kind of a minimum floor. I think you'd really start seeing feasibility at 15 to 20%. And so a lot of that depends on all the costs and revenue variables that are put in the model. So, but based on this analysis, the residual land value for the hotel is negative if you include parking. So what this indicates is the city is going to have to work with the hotel developer to look at ways to make the entire project economically feasible in order to move forward. So the summary of findings: positive indicators, the hotel market is improving. Other factors, there's a lot of supply coming into the marketplace at the same time. City's occupancy rates are up, which is a positive indicator. But at the same time, the hotel will be the first in downtown Livermore, so it comes into an unproven market, and there's both opportunity and risk associated with that. Key market indicators are favorable for development of a downtown hotel, but the cities will need to be willing to partner with the hotel developer and make the overall economics work. And we think a downtown hotel is feasible in the current market, but the cost of the development, land, parking, again, will need to be addressed with the developer to make sure that the appropriate risk is being identified and funded as well. Thank you.